Why would a company willingly pay more than it needs to? Isn't that bad business? Actually, no, not if you're talking about efficiency wages. Today, we're diving into one of the most fascinating theories in labor economics that flips traditional logic on its head. Welcome to the world of efficiency wage theory. Let's start with the basics. Efficiency wage theory suggests that employers sometimes deliberately pay workers a wage higher than the market equilibrium, not out of generosity, but as a strategic move to increase productivity, reduce employee turnover, and boost long-term profitability. Here's the logic. A better paid worker is more motivated, healthier, more loyal, and less likely to shirk responsibilities. In essence, the extra wage is not a cost. It's an investment in productivity. Let's now break down the key features that define this theory. Above-market wages. Firms pay more than the going rate. Why? Because they believe the extra money will be recovered through higher output and lower hiring costs. Motivation and productivity. Think about it. If you're paid well, don't you work better? Higher pay boosts morale and effort, directly leading to higher productivity. Reduced turnover. Hiring and training new staff is expensive, but when employees are satisfied with their pay, they stay longer, and firms save big. Lower shirking. This one's interesting. If an employee is earning more than average, they're less likely to slack off. Losing that job will mean a major pay cut, and that fear keeps effort levels high. Better recruitment. Higher wages attract more qualified candidates. You'll get better resumes, sharper skills, and more commitment. Trust and loyalty. In industries like banking, security, or jewelry, where honesty matters a lot, paying more ensures employees feel valued and are less likely to betray trust. Profitability. Yes, wage costs go up, but if productivity and loyalty go up too, the firm may end up making more profit than before. Where did this idea come from? White-heavy checkmark Adam Smith, back in the 18th century, observed that in jobs requiring high trust, like goldsmiths or bankers, wages were often higher. This was the seed of efficiency wage thinking. Fast forward to the 20th century, and several economists formalized this theory. Shapiro-Stiglitz model 1984 introduced the concept of shirking. If workers shirk and get caught, they lose their high-paying job. That risk keeps them productive. Akerlof's gift exchange model. George Akerlof explained how workers see high wages as a gift, and in return, offer loyalty and extra effort, a kind of informal contract. These models added depth and mathematical rigor to the theory, showing that higher wages can actually be a rational business decision. Let's talk real world. Green Circle Costco versus Walmart. Costco pays significantly higher wages, and yet sees higher productivity, lower turnover, and stronger customer service. Walmart, in contrast, often struggles with these issues. Green Circle Financial Services. Banks often offer better pay not just to retain talent, but also to ensure ethical behavior. A well-paid employee is less likely to commit fraud. Green Circle Tech Industry. Companies like Google and Microsoft offer above-market wages plus perks, not just to attract talent, but to retain it long-term. Let's wrap it up. Efficiency wage theory shows us that paying more can sometimes cost less in the long run. Round pushpin key takeaways. Higher wages can increase productivity and motivation. Employees are less likely to quit or shirk. Firms benefit from a more skilled and loyal workforce. The cost of higher wages may be offset by higher efficiency and lower turnover. So next time someone says, "Why would a company pay more than it has to?" you'll know the economic logic behind it. If you found this lecture helpful, don't forget to like, share, and subscribe to our channel for more insightful lessons on economics.